Let me start with a simple question. Why do so many people believe mortgage rates fall when the Fed cuts rates? The two are related, sure, but not in the way people think. And right now, this misunderstanding could cost you. I wanted to talk about this especially because it looks like the Fed is going to cut rates soon. Now we get to see in real time what happens to mortgage interest when the Fed does cut rates. Here's the truth. Mortgage rates don't necessarily follow the Fed. They're much more closely tied to the 10-year Treasury yield. That's where big investors park their money, and that's what lenders watch when setting 30-year mortgage rates. Case in point, the Fed hasn't touched the benchmark rate in 2025, yet mortgage rates still slid about 0.5% since January. Why? Because investor expectations shifted. Markets see softer inflation ahead, and when Treasury yields dip, mortgage rates often follow. So the Fed is more like the opening act, but the headliner, the one that really moves rates, that's the bond market. Here's where we stand today. According to Freddie Mac, the average 30-year mortgage rate has dropped to 6.29. That's the lowest since September of 24. Not exactly champagne popping territory, but lower than what buyers have faced in the fall of 23 when we were flirting with 8%. Remember that? And while that sounds like progress, economists expect rates to hover in the mid-sixes for a while, enough to keep affordability tight, but not tight enough to freeze the market altogether. I spoke with a young couple last week. They'd been sitting on the sidelines waiting for that mythical Fed cut to bring rates down to 5%. And this happens a lot. Now they're realizing that could be a long time coming. Federal Reserve Governor Christopher Waller just hinted that rate cuts could start this September, small cuts, maybe 0.25 at a time, over the next 3 to 6 months. Now that sounds exciting, right? Until you remember the earlier point. Mortgage rates don't just shadow the Fed. Sure, cuts can nudge the bond market, but they don't guarantee mortgage rates will fall, or at least not as much as buyers hope. So what should you do if you're buying? Number one, don't try to time the Fed. You'll drive yourself crazy. Instead, watch the Treasury yields if that's your thing. That's your best compass. Number two, explore rate buy down. Some sellers and builders are offering credits that let you buy down your interest rate for the first couple of years. That couple I mentioned, they used a 2-1 buy down and shaved almost $500 a month off their payment. Number three, if you're ready to move, consider locking in your rate. Yes, rates could drift lower, but the housing market is already starved for inventory. Waiting could mean paying more for the same house. And number four, don't overlook adjustable rate mortgages. If you know you'll finance or move within 5 years, an ARM might save you thousands up front. This is just an option. Definitely call your lender on that. By the way, if you're looking to move anywhere in the country and you're looking for someone that can help you do that, send me a text or an email. I can help. I'm part of a network that spans the U.S. So here's the point. Mortgage rates aren't waiting on Jerome Powell's next sentence. They're driven by global investors, bond markets, and the collective mood of Wall Street. Yes, the Fed matters, but not the way most people think. So if you're sitting around waiting for the magic number, you might end up watching prices rise while you wait for rates that never arrive. Let me leave you with this. Buying a home has always been a balance of risk and timing, but today more than ever, the winner won't be the one who predicts the Fed. It'll be the one who understands the game. It's the one who is financially prepared and does not make decisions based on headlines. Hey, if you're getting value from my videos and you want to be the first to learn about change in real estate market, hit subscribe, tap the bell. That'll help both of us. Thanks so much. See you later. Talk to you soon.